All right, excellent. Let's get across more on what he's making of the moves. Chris Conway from the Australian Stock Report joins us live from our Melbourne studio. Chris, a pleasure to have you on board with us. Thank you so much. Now, just looking at the ASX 200, yes, slightly weaker there today, 59.80 it's currently sitting at. From a technical standpoint and what you're watching, what are the chances that we can push through that 6,000 mark again? Good afternoon, Leanne.
Look, I'm not sure about the 6,000 in the very near term. I think the region that people need to be more focused on is probably 59.25 to 50. That was a previous swing high that was recently retested as support, and the market has bounced off that. I don't think we're going to see 6,000 challenge today or for the rest of the week for that matter. Of course, it is Friday tomorrow. But that's, of course, because we've got the Thanksgiving holiday in the US tonight and a truncated US session the following night. So even into early next week, we're not likely to see a great deal of leads, at least anyway. So I think it's sort of mid next week before the market challenges 6,000 again. Just to whether the market can eventually get over that hump. Yeah, look, I think it can. The thing that I'm maybe slightly more focused on as opposed to the outline that Martin put forward is that I think global growth will carry us higher. I think commodities are the story that's going to get us over that 6,000 hump. And that's if the banks do nothing bad, which is a bit of an if because, yeah, we worry about a potential Royal Commission. But I think it's that global growth story, stronger commodity prices, and, of course, our commodities heavy market that will push us beyond 6,000 into December.
Commodities perhaps being the engine room for the Aussie market as we do head into the end of the year. Which commodities in particular are you most optimistic on?
So probably at this point in time, I'm far more optimistic on iron ore than I am on oil, and that's because oil will be all about what OPEC does next week in Vienna, I think it is, at their meeting, whether they can agree to further production cuts, and then of course the size of those cuts and moving forward after the meeting, you know, the compliance rates, whether or not countries that make up that agreement can stick to it. That whole scenario has a law of diminishing returns, however, because of course as the oil price goes higher, there's more incentive for countries within OPEC to either not agree to production cuts because they want to take advantage of the higher oil prices, or in fact to cheat after the fact and produce more and sell more anyway. So like I said, oil's all about OPEC and what they do. I'm not quite as bullish about it. Iron ore, on the other hand, look, there's some research that I've been following pretty closely from BNP Paribas, from their quant team, and they look at activity, economic activity in China as well as the impacts of the yuan. The series has only been going for a while, but they have been pretty spot on with the calls that they've made, and they're bullish. I like the look of the research. I like the research targeting around $68 a tonne. So I affirm that research, and like I said, be more bullish on iron ore than I am on oil.
I'm going to introduce my other guest host who joins us in the studio this afternoon, Rudy Philippek-Van Dyke from FN Arena. Rudy, great to have you on board as well. Just your thought there. Chris, obviously fairly optimistic on the outlook for commodities, maybe not so much on the banks. They may not do a lot of the heavy lifting, particularly with the threat of the Royal Commission kind of looming. What is your view on commodities and where to be positioned perhaps as we head into the end of the year?
Well, I think what's underestimated with commodities is that we are now pretty much dependent on what happens in China in terms of policies. So China is changing its policies. China is turning green, essentially. And that has, I mean, the reports I read where people try to assess what is happening indicates to me it's not easy to assess now. Because the effects are multiple. I mean, we see in Australia, for example, that, and I was actually quite shocked recently to discover this, that the iron ore products, which are higher quality than the 62%, are now commanding a premium of 40% on the top of the 62% product. And the 62% itself is commanding 40% as a premium towards the 58% product, which is quite amazing if you think about it. If you're now a high quality pellet seller into China, you're getting 80% more than Fortescue is getting for its lower grade products. That effect, we don't really know exactly how that's, because on the other end, they are restricting steel demand, both on the production side and the big projects. We don't know exactly how that's going to translate into the lower product supply in China. And what we do know at this point in time is that, for example, the imports from India have completely come to a standstill. Now, India is not a big player, but still, it's a player in the fringes. So while BNP Paribas from the quant side might have a nice report, I very much doubt whether they've taken all these elements in and nobody knows this. This is new. China has been talking about this for years, has sometimes implemented those policies and they haven't been followed through. This time they are implementing them and they are being followed through. And we're basically going through a point where we have to find out, in certain scenarios, what we might be witnessing here is a bull market for the Vales, the BHPs and the Rios of this world, and not so much for all the rest, while they're all in iron ore. And I think this is an element that is quite new for resources, because previously it was bull time for everyone, bear market for everyone, and now that is changing.
Yes.
And I'm not so sure whether investors have caught up with this dynamic just yet.
Yeah, so as you say, very much a focus now between the high grade and the low grade iron ore. You mentioned, Martin, that you are, fairly optimistic as well on the outlook for commodities. Is that something that concerns you, though, for the Aussie miners, what Rudy was just pointing out, with China sort of favouring the higher grade products? Yeah,
I mean, that's clearly what's going on right now with the shutdown of the steel mills. But, I mean, some of that's structural, as Rudy said, some of that's seasonal, just going into winter. The discount itself is also quite cyclical. The discount that Fortescue got, which Rudy said is kind of around 40% at the moment, that tends to go up and down with the price itself. So, when they're looking to expand and restock, they do buy low quality material as well. So the discount can narrow. So, I mean, you can trade that discount. You can do the pairs trade on Fortescue Rio if you want to play that discount story. But we're quite constructive about world growth and China in particular. So China's slowing down, but not as much as people fear. So we quite like them. Like, we added Fortescue to our model portfolio in the last couple of weeks because we think it's got to a price that reflects the concern about the discount, and we think the outlook looks quite good.
Chris, just back to you, and I'm interested in your thought on the oil price, because we know that it's been well supported right now. There's been obviously ongoing geopolitical tensions within the Middle East. There's a lot of optimism, though, that seems to be built into the price around the OPEC meeting next week. Your thoughts on that, and whether OPEC can actually do it when they meet next week, and how much that will support the price going forward?
I think it's a big risk, Leanne, and there's the potential there of the whole buy the rumour, sell the fact. So, look, as I was saying, I don't deny that OPEC can come to agreement again and agree on further production cuts, but as I was saying before, it's a law of diminishing returns. As that oil price goes high up towards $60 a barrel, there is the incentive, and it becomes a very, very strong incentive for OPEC nations, member nations, to not agree to further production cuts to take advantage of that higher oil price. Or, as I was saying before, post the agreement, cheat, which is what they used to do. Compliance rates of the late agreements have been north of 80%. That's almost unheard of in the history of OPEC. So, they've got to work very hard to maintain those compliance rates. And it only takes, we know the economics of a cartel. It only takes one member to start cheating. Then, of course, they all start cheating, and all of a sudden there's far more production out there than what they had all envisaged, and the price comes crashing back down. I think the natural price for oil, so uninterrupted by a supply side, intervention, is around $50 to $55 a barrel. So if they can't come to agreement, naturally I think there's a pullback into that range.
One of the other things, of course, we haven't touched on is those currency moves. We want to see, I suppose, a weaker greenback along with a strengthening Aussie dollar. I suppose weakness in the greenback would be it could lift all tides, I suppose, could lift all boats there. Your thoughts on that, particularly in a rising interest rate environment? How likely is it that we would continue to see weakness in the greenback?
Well, it has been weak of late, and yeah, look, you took the words out of my mouth, Elaine. That is the rising tide that could lift all commodities, because of course, as we know, the traditional relationship is that a weaker greenback is better for commodities in general. I think everyone's priced in December. I think we know that's coming. I don't think it'll be any shock to anyone, and I think it's already priced into all the models that all the quants around the world use to come up with their predictions and their analysis. It's what the Fed says about the likely future pace of interest rate hikes that could shift what the US dollar does, and then of course what happens with commodity prices. I won't hazard a guess at that. They came out in December last year and said they wanted 4 this year. Well, we're going to be in December next month, and they'll get the 1 away like they have for the last 2 years. So, They can say one thing, they might end up doing something else completely different altogether. But as I said, I think the relationship holds that whilst the US dollar continues to go down, commodity prices should stand to benefit.
All right, excellent. Let's move on to some individual stock movers that we're watching today. AGM season, as we mentioned, really in full swing. Woolies is on the agenda there today. Not a huge move in the share price. Rudy, just wanted to get your thought. The 92nd AGM there in Melbourne today, and it seems like they've laid out their plans to kind of tackle the threat of Amazon here. But I mean, given that the fact, the groceries, not sure how likely a huge impact will be from Amazon there. Did we hear anything kind of significant out of that AGM today?
Well, there's always plans, and they're far more to deal with than just Amazon. There's subdued retail spending, I would think, is a priority number one. In general terms, I don't think we should expect anything spectacular from Woolworths for the near to medium term, and that both goes on the negative side and on the positive side. Right? And whether that excites you or not, that's dependent on what investors are looking for.
Martin, is Woolies a stock that you get excited about?
No, look, it's hard to get excited by it. I mean, I think it's probably fairly valued. It's obviously, it's recovered, so it was getting smashed by Coles, right? And Brad Banducci's gone in there and cleaned the thing up, and they've definitely turned around their same store sales. I mean, the numbers that came out the other week were pretty good though, sort of 4 or 5% recovery in supermarkets, and they said at their AGM that momentum has continued. But I think to see the share price a lot higher, firstly, Amazon has to go away, and Aldi has to go away, and Nordstrom have to go away, and everybody else, right? Kaufman have to go away.
Well, that's not likely anytime soon, is it?
That's not going to happen, right? So you kind of go, well, we're just going to plod along on this thing. It's going to run to stand still, and it'll give you a dividend yield and maybe a bit of capital growth. So it's kind of hard to get excited by it, Leanne.
Yeah, okay. Chris, your thought on Woolies today? It seems like that turnaround story certainly remains intact. Your thoughts on the stock going forward? Is this one that you like?
No, I like the panel. I can't get excited about it either. I think Martin really hit the nail on the head. If all the competitors went away, might be a completely different story, but that competition is coming, and it's coming thicker and faster even than it is now. So, yeah, turnaround story remains intact, but it's an ever more competitive space that they're trying to operate in.
We've been talking, of course, a lot about Amazon and the entry, their soft entry here in Australia today. So we've been bracing for this. We've been talking about it for months on end, and finally it's going to be here. Your thought on the retailers? I mean, we often mention a Harvey Norman or a JB Hi-Fi, those ones that are likely to be impacted or hurt the most from Amazon's entry. Are there any retailers that you like right now, though? Kathmandu, I think, is one that we've spoken to you about previously.
Yeah, Kathmandu would certainly be one of the few retailers that I like. Certainly a specialist retailer. Have had great sales numbers over the last years. I think 5.5% growth in like-for-like sales. They just seem to have done everything right over the last 18 months in terms of paying down debt, managing their inventory, pardon me, not putting too much stock on sale. So that is one that I would happily be invested in. But yeah, look, I think everyone's holding their breath now, waiting for Amazon. Me as a consumer, I'm really excited about it because it means I can get good products at a cheaper price. But in terms of putting my investment hat on, yeah, I think we need to sit back for the moment, measure the impact, see what the impact is, and then make decisions accordingly.
Rudy, your thought on the impact? Yes or no? We've spoken about it ad nauseum, it seems like. Those ones that you think are going to be hurt the most?
Don't own any of them.
Okay.
Is my best.
Because of Amazon, or also because of weak consumer spending, like you mentioned earlier?
I think the combination of both. And I think that the major threat here is consumer spending. If anything, if consumer spending stays in the current trend, it's going to get much worse. Yeah. If it stabilizes here, then we're still talking about a considerable lower trend rate than we used to have only a few years ago. Every retailer will feel that. Then it just becomes a degree who feels less than the other guys.
And who adapts better, right?
Well, exactly, and adapting takes time and may actually require investment, which then also will depress the share price and the profits. My favorites are the ones who are also exposed to consumer spending, but not really retailers, and we're talking about the likes of car sales, REA Group, and maybe a Bapcor. But I haven't been around retailers for years now, and not one single morning have I got up in my bed and regretted that I didn't have a retailer in my portfolio. Yeah.
Martin, for you, do you own any of the retailers?
No, not really. I think It's probably worth looking at Harvey Norman and JB Hi-Fi though, because obviously consumer electronics is the area that everyone said Amazon's going to kill those guys. And look, Amazon's going to take a long time to build out their footprint and their logistics and their stores and everything else. So it's not going to, you know, it's the demise of these guys, but it's not their death, if that makes sense. So I think you can still probably make money out of those guys, but that's a bit of a brave call. So probably like Rudy, probably just stand back and watch the fight and wait till the blood's on the floor and then have a look later.
All right, excellent. Look, we're going to be talking more about the threat of Amazon later on in the program. For now, though, we'll have to leave it there. Chris Conway, pleasure to have you on with us as always. Thank you so much for joining us.
Thanks, guys. Cheers.
Chris Conway there from the Australian Stock Report.